When will the property market slow down and actually correct in prices? It's unaffordable and it's a bubble. It's also a Ponzi. In this video, I'm going to break down a bit of a forecast, a bit of a game plan as to what we think will happen, not just in terms of property prices, but going beneath that and understanding supply and demand. If you guys are interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Instead of asking, when will the property market collapse? Or when are the prices going to be more affordable? What we need to do is look at a layer beneath that, which is what's happening in the economy right now. And as well as that, is there incoming demand and what does supply look like? Because if you can understand those three, you're going to get a really clear picture as to where the market's headed. Now I'm going to show you a glimpse of a video I made in 2020. It was April 2020, a lot of fear in the system, and I had so much conviction with my $15 whiteboard from Kmart, and I was just pounding. I was screaming at the top of my lungs across every social media platform. I didn't have many people following me at the time, but I put up this video. So we're going to see this period, and I expect that it's going to be about 2 or 3 months of this uncertainty. We're already seeing positive news with the coronavirus in terms of how we're dealing with it as a country. And then you're going to see an absolute growth period that we've never seen before. Now, I say this not because I'm in the property market, but because I understand how it works. Now, everything will rise in price. So wages increased, rent increased, house prices increased. Debt will not increase. So, I don't even know why I'm drawing a graph. No time for graphs, my friend. If you buy a property today for $250,000, we know, because of the example I've just shown you, that the money value drops. So if everything drops and now you're making $250,000 a year, you could effectively just buy one of these every year. So that causes this to go up. So now the 250 has gone up and now it's worth 450. This then causes what we call the wealth effect. And the reason it's called the wealth effect is because now you think you're wealthy. You go, hey, wait, my property is now worth $450,000. My debt here was, let's say for argument's sake, was a 200K loan. Okay, so does my loan go up? No, it doesn't. Your interest rates might go up. You purchase in today's value and the debt is in today's value. Tomorrow's value, your price has gone up. It's now $450,000, but your debt stayed the same. So what you could do is imagine if you had 5 properties, right? You had 5 properties, you purchased them all at 250, and so that's equals to 1.25 million asset value, and the loan was 1 million. Now, if the value goes up, which it will, because we've understood how it works, and this is why I said context is key here. You understand why I'm saying the property prices will go up. So then you've got this valued at 450. So now you've made a profit of 200 on each property. So that's $1 million, right? All you'd have to do is literally get 2 of the properties or 3 of the properties and pay down that. And you'd have 2 or 3 properties for free. And that is essentially why we are in the greatest time to be purchasing property. It's better than anything I've experienced. It's pretty much going to be better than anyone experienced over the last 10, 15, 20 years. And why I'm saying you need to align yourself with a professional that knows where to be purchasing these. Not everything is going to go through this growth. Not everything will, right? We've secured our real estate for the growth that we're going to see of whoever knows. I predict we could see numbers anywhere from 15 to 25% of growth. And I know some of you guys are sitting there and going, this guy's a load of shit. I don't understand how he's getting these numbers. If I told you 2 months ago that we would all not be allowed to leave our houses, we're not allowed to leave home, we can't meet other people, we can't meet friends, and there's social distancing is a thing, you would have thought I was an idiot as well. I am saying today that we are going to see the greatest property increase in price action in our lifetimes. This is a black swan event, guys, okay? Get educated as quick as you can. If you need the help, contact me. But if you can secure something now, you've got to ask the question, if you purchase here, maybe they're available. You purchase here, maybe there's a few less available, but now the buyers are coming in, they're getting a bit more confident. But what most people will do, and you're not those people, the 99% are gonna buy here or want to buy here. And FOMO is gonna kick in, and that's just gonna fuel this. And most people will end up buying about here, and that's when they're gonna get screwed over.
Now you can go check out the entire 40-minute video where I go on a rant and what I think was gonna happen in the market. And yes, I was wearing a business shirt, which doesn't feel natural, but I'm here now with my black t-shirt. The reason I bring that up is because the level of conviction I had back then is nowhere near the levels of conviction I have today. And what I mean by that is I have so much clarity and conviction around where the market's gonna be headed in the next 3 to 5 years. And I know no one really knows the future, but we know that cycles often rhyme and to a large extent repeat. And what we can see is all of the same things happening exactly right now. And I'm not referencing just the 18.6 year cycle, which suggests that the collapse should be in 2025 and 2026. I honestly believe it's closer to 2028 to 2030, and it's gonna extend. And I believe that a lot of people are gonna get caught off guard because a lot of people are thinking, no, gold prices are at all-time high, silver's hitting all-time high, surely there's a collapse coming. Surely there's a recession. And to be honest, the recession always gets calculated after the fact. So by the time it actually is recognized that we're in a recession, especially in the US economy or the Australian economy, it happens after the fact. And that's when max fear is in play, and that's usually the best buying opportunity. So let's look at some data points. Let's really understand what is happening and when realistically we can see an equilibrium in the market when it comes to supply and demand. Right there is going to tell us a clue as to when the market is going to slow down. Whether one takes their data from private providers such as AMP or a public source such as the National Housing Supply and Affordability Council, it's no secret that Australia has a troubling shortage of homes. According to the NHSAC, the nation's housing shortage worsened by 47,000 homes during the recently ended 2024-2025 financial year. Based on their estimates from July 23 to the end of September 25, the demand for housing expanded by approximately 137,500 homes, more than the aggregate net supply growth across the same period. And what that looks like is right here. This table forecasts the new market supply, demand, and net balance. So we've got is the year, and of course we're here in late 2025. So a lot of this is forecasted, but what we can see is gross new supply, then net new supply, new demand, and then net balance. So that's the net new supply less new demand. So effectively, how much demand do we have versus how much supply is there? And what we can see is in 23-24, net balance was minus 86,000. Last year, it was minus 47,000. In 25-26, it's going to be minus 18,000. And then it gets to minus 7,000, minus 5,000, minus 3,000. Now, while you can see this number is not looking as tragic, and you're like, well, how do you get to a market correction, say in 2028 or 2029, when realistically, it looks like we're going to be a pretty much balanced market by the time 2026 comes around? And that's actually incorrect. Because what this is suggesting is that we're still going to have a shortage every year. It just means the amount in terms of the shortage we're going to have is just declining. But overall, it doesn't offset all of the shortage we've already had in the system. So it's really relying on all of this increased supply coming onto the market. But all it's going to do is it might just keep up with the demand for that year. But it doesn't address the fact that we're still in a shortage. So if you think about it, you could go, well, I'm minus 100,000 homes right now. But every year from now, we're going to meet the target. It's going to mean that if people want 50,000 homes, we're delivering 50,000 homes. That means it's a net balance. That's great, isn't it? Well, no, it's not, because it still doesn't address the fact that you're negative or deficit 100,000 homes already. So over this period, we're going to have net new demand of 904,000, net new supply of 825,000, which means by the time we get to 2028, 2029, we're still going to be negative 79,000 homes. Now, the housing shortage calculations of AMP Chief Economist Shane Oliver take a longer view, beginning all the way back in year 2000. Our assessment is that the accumulated housing shortfall is around 200,000 dwellings at least, and possibly 300,000 depending on what is assumed in terms of the number of people per household, the prominent economist wrote in the recent note. So if we look at this, we can see home construction and underlying demand. So again, in the blue, underlying demand, in red, dwelling completions, and here in the green, we have accumulated undersupply of housing. So if it's below this line, we're in oversupply. If we're above this line, it's undersupply. And what we can see is a couple of interesting things. And I'm going to overlay some data as well that you're going to find interesting. So what we can see is that from the period of 2026 going up to about 2025, we've seen a constant undersupply of property. And guess what happened between 2026 and 2015? We saw massive price appreciation. Now, of course, we did have the GFC and it slowed down things, but realistically in the Australian market, we still saw markets go much higher. But what we can also see is it sort of topped out around 2014, 2015. And then we saw that market actually decline, which means in this case, there was more supply coming onto the market. What this did see is prices fall and soften in a lot of markets. And I remember purchasing property all the way through this period because I bought my first property in around 2013, 2014. And I saw the market sort of slow down. Although I was still getting gains in the market, it did slow down a lot. And around 2016, 2017, I know markets like Sydney topped out for a period of time. And that was because APRA came in, changed up a couple of the rules when it comes to lending, especially around interest-only loans. And then that meant we had a slowdown in the market. So not just from a supply point of view, but other market forces, being the availability of credit actually tightening. And that's something to keep in mind because this can address supply and demand when it comes to new houses being built and constructed, as well as how many people want to live in a house. But then if you go to the other side, you've also got the availability of credit, which could be the crunch or the accelerator in the market as well, which we're going to touch on in a second. And then of course, in 2021, we saw that trend absolutely go the other way, and we've seen the undersupply continue much, much further. Now, if you actually look at this, yes, we're starting to forecast that maybe it's not going to be as bad, but it's a forecast. And that's where you've got to be really careful because the government also came out and said, we're going to go and build 240,000 homes every single year. They've never done it. In fact, the highest amount of approvals was like closer to about 200,000, and approvals don't mean completions. So when you think about the 18.6 year cycle and you think about, hey, maybe we're going to have this slowdown in 2025 and 2026, and this is the worst time to be buying property, ask yourself this. How exactly is that going to be triggered? You've just had the government come out and announce a 5% deposit scheme, which is absolutely going to tear the market. You then, on top of that, have interest rates cutting. And because they're not just nosediving, it means that the economy is stabilized and it's stabilizing a lot better than expected. So it means they don't have to cut every single month. They cut, pause. Inflation seems to be okay. And yes, it trends a little higher, trends a little down. And the same thing with unemployment. So it looks like the economy is pretty stable when you look at those factors. What the banks are doing are cutting interest rates. So now it's easier for people to get into the market, and that creates money in the system. Because guess what? If you go to the bank and say, I want to buy this property, I can put in 10%, you put in 90%. Where did the 90% come from? It's new money that's created into the economy, and that means there's more money supply, and that means when you're going and denominating that against hard assets like Bitcoin, like gold, and most importantly, like real estate, it means prices head much higher. So if you think about that and overlay that with how bad our shortage is in terms of property here in Australia, you've got to factor in that we've also got really high levels of immigration. To cap all of that off, if you think about where prices are now and where prices could be in the next couple of years, I still don't see a world in which we see a massive correction at least for the next 2 to 3 years. After that point, we need new data points. We need to know if immigration has slowed down. And this is exactly why you're seeing the re-acceleration in a lot of markets, including something like Perth, which just simply has not enough properties available to sell and not enough properties to actually rent. And that's why you start seeing articles like this come out where home price growth is to reach double the 2025 expectations. National home prices are on track to double annual growth predictions after buyers took advantage of falling interest rates to secure a property in the tight market. At the start of the year, housing researcher PropTrack forecasted prices would rise 4% through 2025. However, on the current trajectory of growth, property prices are expected to reach 7.8% by the end of December. Housing researcher Cotality Research Director Tim Lawless warned the re-acceleration of the market would be a consideration for the RBA. The number of homes listed for sale is almost 20% below the 5-year average. This disconnect between available supply and demonstrated housing demand is fundamental to understanding the upward trend in housing values, Mr. Lawless said. And I made a video on this channel, and you should definitely go check it out next, that suggests how big of a deal this 5% deposit scheme actually is. Because we haven't seen something come into the market at these levels. And the ripple effect that you're going to get from this is much bigger than most people expect. So definitely go check out that video after this one. If you have enjoyed this one, smash that like button so we can push these videos out to more people that need to know what's actually happening and not just get sidelined because they think, hey, maybe it's going to crash and maybe I can buy the same property on my street for 30% less. Sounds good, but it's not going to happen. I hope you guys have enjoyed this one. If you have, smash that like button and I'll catch you guys on the next one. Thanks, guys.